Hi, I'm Keith Quinn, the Director of Investments for Shoemaker Financial with an economic update for July of 2017. In this month's update, we'll talk about some of the economic news that's impacted the markets, and hopefully we can give you some insight into what these developments could mean for you as an investor. Well, the first half of 2017 is officially behind us, and it was a period marked by strong stock market returns and exceptionally low volatility, and that was even despite the ongoing conflicts in Washington. In fact, the S&P 500 had its best start to the year since 2013, gaining 9.34%. And the NASDAQ Composite did even better, posting its best start to the year since 2009 with a 14.71% return. But U.S. companies weren't the only ones to start the year off with a bang, as companies in Europe, as measured by the MSCI EAFE index, gained 14.23%. But the standout was definitely in the emerging markets, with the MSCI Emerging Markets Index leading all comers with a whopping 18.6% gain. And while it's virtually impossible to attribute the gains to any one factor in particular, it certainly appears that stocks were lifted, at least in part, by the sense that other global economies outside the U.S., and particularly the economy in Europe, are finally starting to stabilize. So how has our economy done here at home? Well, we slowed down less than expected in the first quarter, with the final estimate of first quarter GDP growth coming in at 1.4% due to higher than expected consumer spending and a bigger jump in exports. But even at 1.4%, that's still the slowest growth we've seen since the second quarter of 2016. Now on the jobs front, the economy added 222,000 non-farm payroll jobs in June, and that was in addition to April and May being revised higher by 47,000 jobs. So job growth has been fairly steady. And along with the job growth, we see that consumers seem to be feeling better about their ability to pay their bills, take trips, and cover their expenses. But at least so far, that increased confidence on the part of consumers has failed to translate into any significant increase in consumer spending. In fact, retail sales in June were actually down 0.2%, with sales at department stores dropping 0.7%, and sales at restaurants dropping 0.6% for the third decline in the last 4 months. And when you couple that with the savings rate ticking up to 5.5% in May from 5.1% in April, all the talk about the improving mood of the consumer doesn't seem to be matching up with the hard data, at least not yet. Now there's also a lingering concern about the extended length of the current economic expansion and whether it's sustainable. But think about this. Since World War II, the average U.S. expansion has lasted 64 months, with a cumulative growth in gross domestic product of 24%. Now that's versus the current economic expansion, which has lasted 95 months. But here's the kicker. During the current expansion, GDP growth has only increased by 17% versus the long-term average of 24%. So even though the current expansion is a little long in the tooth, we still have room to grow given the slow growth we've experienced since the Great Recession. Now, as I mentioned earlier, the growth story isn't just limited to the U.S. In fact, for factories located in the Eurozone, June was their busiest month in more than 6 years. And that was led by increased manufacturing activity in Germany, Austria, and the Netherlands. And get this, even Greek manufacturing picked up speed in June, even though it was only slightly. And along with the improving outlook in Europe, the world's second largest economy in China reported second quarter GDP growth of 6.9%. Now that matched the growth they had in the first quarter, and it calmed fears of a Chinese hard landing and the concerns we have over leverage and high debt levels in the Chinese economy. So what can we expect from the markets over the next 6 months? Well, looking into the second half of 2017, Wall Street will definitely be focused on whether corporate earnings can continue rising at a healthy pace despite the dysfunction we're seeing out of Washington. But it does seem pretty unlikely that the low volatility will persist indefinitely. So investors may need to buckle up for more swings in the markets in the coming months. Now some say the best days for the stock market have already occurred this year, and that any future gains may be imperiled by a market that's become too expensive, by political gridlock, by a slow-growing economy, and by worries about top-performing tech stocks cooling off. And there's also a feeling that the market's fast start has stolen from gains that may have come later this year. But I'll be honest, the bottom line is we just don't know, because as always, and especially in the short term, the future is unknown and unknowable. So what do? Well, we focus on the fundamentals. And since we can't predict the future or control the markets, we focus on the things we can control, like the allocation of our investments between stocks, bonds, and cash, like diversifying our investments across different parts of the global markets. like periodically rebalancing our portfolios to ensure that we sell high and buy low. And no matter what happens in Washington, no matter what the latest crisis du jour happens to be, we always, always, always maintain our disciplined approach and stick with our plan. Because ultimately, if our goals haven't changed and the time we have to accomplish those goals hasn't changed, our portfolio probably shouldn't change either. Well, that's it for this month's update, and please remember that nothing we've talked about here should be taken as a recommendation. But if you'd like some more guidance on how to structure your portfolio to optimize the chances of hitting your goals in the current environment, always remember that we're here to help. So please don't hesitate to reach out to your advisor, or you can always give our office a call at 1-800-757-1059. Until next time, I'm Keith Quinn for Shoemaker Financial, wishing you continued peace and prosperity.
While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. This material represents an assessment of the market environment at a specific point in time and is not intended to be a forecast of future events or a guarantee of future results. The S&P 500 index is an unmanaged index generally representative of the U.S. stock market. It is not possible to invest directly in an index. Investments will fluctuate and when redeemed may be worth more or less than when originally invested. Past performance is not indicative of future results. The NASDAQ Composite is an index of the common stocks and similar securities listed on the NASDAQ exchange. It is considered a broad indicator of the performance of the stocks of technology companies and growth companies. The MSCI EAFE index was created by Morgan Stanley Capital International and serves as a benchmark of the performance in major international equity markets as represented by 21 major MSCI indices from Europe, Australia, and Southeast Asia. This material has been provided through the research of Platinum Advisor. Keith Quinn is a registered representative and investment advisor representative of Securian Financial Services Incorporated, member FINRA SIPC. Securities and investment advisory services offered through Securian Financial Services Incorporated. Shoemaker Financial is independently owned and operated.